You're listening to the Moose on the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from the Moose on the Loose. Happy Thursday. Today, we're going to do a look back at one of my trade in 2023. We're going to talk about Enbridge. We're going to revisit the business model, and we're going to determine, is it set to surge again or not? Because that is always a question, right? All right, so I sold Enbridge in February of 2023, if I remember correctly. And then the stock since February 2023 is up 35% total return. So stock price plus the dividend, of course, that's the only way to look at an investment, like the total return. So you cannot just look at the dividend. You cannot just look at the stock price. You must look at the whole transaction. So up 35% total return, pretty much in line with the TSX 60, that has been up 37.7, so 38% since February. Keep in mind, for like small, like we're talking about like not even 2 years and a half, that is like a super short period of time. So if you're 35 or 38, I mean, you're in line. You're exactly the same. It's the same returns. That could have gone like in any kind of other ways. So it's just too early to say if it was a good trade or a bad trade. Actually, throughout the entire year of 23, that was a good trade, and then eventually it came back up. For the full story, when I sold Enbridge, I bought CCL Industries instead, which this one is up 34%, including the dividend. So 1% less than Enbridge, 4% lagging the TSX. So overall, pretty much a neutral trade so far. There were like some moment where one was a big winner, one the other one, whatever. I mean, after 2 years and a half, I would have showed the same portfolio value, like roughly, if I had kept Enbridge or if I had gone with CCL, which I did. So a lot of investors, though, investors being investors, I guess, they only remember the stock price at Enbridge bottom around January 1st of 2024. So for the past 18 months, the stock price exploded by 42%, including the dividend. So I mean, it's just like people just looking at like, oh, let's take a look at when the stock price was so down and now it's going back so up, and now it's just amazing company. So again, making that mistake, in my opinion, respectfully, to focus on short-term performance of the stock to determine if it was a good investment or not. So, and I'm not saying it like Enbridge is a bad investment. I'm just saying that now you're painting something that is incredibly rosy and like with rainbows and unicorns, because I don't think Enbridge is going to go up by another 40% in the next 18 months. Actually, if you look at the stock price graph over the past 6 months, the stock has already went a little bit sideways. So it's up, I think, like 3 or 4% year to date, including the dividend. So the dividend is actually saving the whole thing right now. So not exactly a surging stock at this point. So now let's take a look back. Let's revisit Enbridge to see if anything has changed or if it's just like the stock price moving up and moving down. So for the bull case, I like to separate the bull case in three segments: the playbook, the growth vectors, and the moat. Helps me understand a little bit more like what the company does and how it will continue to do well, actually, or grow. So the playbook, quite simple in this one, very impressive pipeline network. So both crude oil and natural gas. They use take or pay contract, very long term. So they charge like A+ companies, I would put it that way, to use their pipelines to transport and store natural gas and crude oil. So very high quality client, very long-term contract. Earnings are regulated. They are shielded from price fluctuation. They are shielded against inflation. Everything is built in those contracts. So they have this great protection. So the table is set for a very stable cash flow. Growth vectors, of course, expansion of existing pipelines, new projects, more transportation, more storage, and of course, the ability to increase price. Because of course, when you're dealing with those clients, you can say, well, price is going to increase upon renewal of the contract, or there's also clauses in the contract that will increase price of transportation. So all of this is good ways for Enbridge to keep on growing their revenue and earnings. In terms of economic moat, well, super high barrier to entry. It's capital intensive. I would not be able to start my own pipeline company tomorrow morning because of the money that is required, but also because regulation goes both ways. I mean, of course, it will be part of the bear case as well, but regulators will also kind of like protect the ones that are already in place for the pipelines. So very hard to get into that business. Very sticky business as well due to the contract. So very hard to shift from one place to another. Once your business is fully integrated, like you need that oil, you need that natural gas. Well, there you go. You're just gonna pay for that transportation in the pipeline. Everything is already connected, so makes your life a lot easier. Does it translate into numbers? Because that's the first thing. When you have a great investment thesis, you want to double it back with numbers. So looking at the dividend triangle, the earnings per share, you have to look a little bit also for the DCF, distributable cash flow per share in case of Enbridge. The revenue, the EPS, the DCF, everything is going up. As of late, actually, big jump. So that was great. It supports a 3% dividend increase for the past few years. If you look at the DCF payout ratio, everything looks great there as well. So I would say at this point, still, since the growth vectors are not like incredible, they're there, but they're not incredible. Pretty much like a classic deluxe bond, which is actually not bad. It's actually good. If you love to receive higher income from your investment, Enbridge is part of those rare high yield stocks that is not struggling to increase its dividend. It's still safe. Now the interest rate has gone a little bit lower. It also helps them to move forward. So overall, so far, so good. Enbridge still ticking a lot of boxes for a lot of dividend growth investors. Now the bear case, because I mean, it's great to tell you about how everything goes well, but sometimes it's not the case. So again, I like to segment this part into three parts: business vulnerabilities, industry and market threats, so everything that the company does not control, external, and then competitive landscape. So for the business vulnerabilities, I'd say, while the mainline pipeline is amazing, the company heavily rely on this pipeline to not only generate cash flow, but to grow its business with expansion and so on. So any underutilization of the mainline pipeline will also affect results. The biggest downside I see at Enbridge, and that was the reason why I sold in 23, is the debt load. They keep on talking about like opportunities in billions of dollars. Management is like super excited about that, but their CapEx budget is like through the roof, and the debt increases every single year. Like there's no debt payment plan or anything. It's just like, oh, let's get more debts to buy more assets and generate more cash flow. I heard that song. I think it was like a telco that kept singing that song at one point, and we all remember how it ended up. It took a while, but at one point you hit speed bumps that could like be dangerous. So that's definitely the biggest concern I have about Enbridge. And don't tell me it didn't happen. I mean, Kinder also kind of like did a Kinder surprise on investors about, I don't know, at least like a little bit more than 10 years ago, but still, Kinder was like a great pipeline company, cut their dividends. So it's not impossible. Never say never, right? Industry market threats. Well, regulators may slow down some expansion. There's always that risk. Laws keep on changing. So sometimes it's a good time to be in the pipeline business. Some other times not so much. So you have to consider this as well. So the growth may be limited by both the business model and also external threat. So you have to be aware of that too. In terms of competitive landscape, well, then you have the choice, right? You can go for like something a little bit more geared towards natural gas with TC Energy. You have Southbow that is more like a pure play on the crude oil. Enbridge is almost like half and half these days. You have Keyera, you have Pembina pipeline. So each of those companies have their pipelines, they have their route. So that's great because it gives them their economic moat per se, but you have like other opportunities if you're looking for pipeline as well. I would not like buy 5 of them. As you know, I like to just buy my favorite one for each industry. So there you go. So in conclusion, is Enbridge is going to set the surge again? Is that 40% total return over the past 12, 18 months is still something that could happen again? I highly doubt it. I mean, if you look at the stock price over a long period of time, you will notice that it's not the first time and certainly not the last time that Enbridge goes down and then goes back up and then goes down and then goes back up. So it is, and don't get me wrong, I'm not saying it's a bad stock. It's a great company. I bought it when it was down. I sold it when it was up. I was super happy with the returns I made on Enbridge when I did that trade. Right before, like towards the end of 23 was another good timing to buy it, and then probably selling it around right now if you want to make like a very good profit right away. It is a fluctuating stock, so it's going to continue this way. Actually, on the positive side, management is expecting pretty much all metrics to go up about 5%, which is pretty cool for a slow growth company. So we're talking like expectation of like 5% growth for EBITDA, for earnings per share, for distributable cash flow per share, so DCF, and even potentially the dividend increasing like from 3 to up to 5% a year. So that would be crazy. Again, I'm still concerned about the debt though. That's the main reason why I sold in 23. It's still the main reason why today I would not go back in, but I mean, in the end, it was not a bad trade. It was not a great trade. It was just actually a neutral trade, but I feel better with CCL Industries in my portfolio than Enbridge. And I'm not telling you that you should feel better with one or the other in your portfolio. The point here is you see how it's only a matter of like the level of conviction here, not necessarily which one has been the best investment. So if you feel better with Enbridge, that's the key point. It's not a bad business, so you should be good. But if you have concern like I did, well, maybe it's time to find a replacement. One thing is for sure, I don't expect Enbridge, now that it has like recovered from the latest drop, I don't expect it to jump by another 30-40% in the next 2 years. Maybe I'm wrong, but we'll have to see. So anyways, that was a good revisiting and kind of like interesting to see that on one way or another, I would have ended up with the same results. All right, Moose, that's enough for today. Tomorrow, we're going to talk about managing a retirement portfolio in the Trump era. What should you do? What has changed? What's coming up? It's all there tomorrow morning. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.